How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options training program. Want to give you a real quick heads up. Could you do me a favor? Like, share, subscribe to the particular content. We're trying to grow the platform out, trying to grow out the channel. Would really appreciate the support. What we're going to do is we're going to do Market Mondays for 3/22/2021. Really quick heads up. It's just the first time you're here. We do Market Mondays to try to give people a really fundamental understanding of the stock market in the common tongue. We don't want you to make you think that you got to have a PhD. You got to have this, formalized education to really understand the market. And we want you to kind of understand what the market can do for you, how it can help improve your life, how it can help you get the life that you desire, how it can help save a lot of your time, and how it can help you actually build the kind of wealth that you think you want, that you may think that you have to get in other areas because you were maybe not aware of how you can build wealth utilizing the stock market or the financial markets. So what we want to do is have you take some of these conversations back around your group, to your community, start having them and start building up your understanding of the market. Let's go ahead and get into it. So today the market was relatively green. Dow Jones was up around 0.32%. And I think that's, 0.32. S&P 500 was up 0.7. NASDAQ up 1.23. And then what we saw was that the 10-year treasury yield stood around 1.68 today on Monday. So we think that's one of the reasons why the market was kind of green. Because we think, and we talked about this earlier, that people are getting desensitized to the treasury yield. So there was about 2 or 3 weeks ago where the treasury yield around 1.6 made the whole market sell off. Then Friday was around 1.7. So then now on Monday at around 1.6, nobody really pays it any attention. So we may see people becoming desensitized to this treasury yield, which means that maybe they can continue to walk it up. And as more and more people get exposed to a higher and higher number, as long as they have longer exposure to that higher number, they just get desensitized to it, which is part of human nature. Then Jerome Powell said today on Monday that Bitcoin lacks the key ingredients that will make it a useful currency. However, he said that saying that cryptocurrency instead is more of a gold substitute. And let's get into that a little bit without sidetracking the whole broadcast. I can understand why he could say that it doesn't necessarily have the key ingredients to make it a useful currency, because one of the reasons is that it's very, very volatile. And him being chairman of the Fed, he's interested in having stable markets. So when you look at something like Bitcoin, we can buy item A with Bitcoin today. Let's say we pay, let's do it in Bitcoin. Let's say hypothetically we pay 1/4 of a Bitcoin. And then because of the volatility of Bitcoin, that same item next week could be worth half a Bitcoin. But it's the exact same item. That's going to be very difficult for consumers, because consumers in America are used to saying, hey, you know what? I go to the grocery store and I buy eggs and they cost $2. And when I come back next week, eggs are still $2. The American consumer is not used to, I go to the grocery store to buy eggs and they cost $2. And I go to the store next week and eggs may cost $20. That'll throw them off, because why? Well, their income is still the same. So Bitcoin is so volatile, it may be difficult or challenging to make it a very useful currency because of its volatility, and they don't have any way to stabilize it, because what? There is no central organization governing it. So then you can't create methods to make it more stable. It's just going to do what it does. So, it's a very volatile currency or a very volatile instrument, and that's what it is. Now, him saying it's more of a gold substitute was where I disagree. And this is the reason. There is a possibility that 100 years from now, Bitcoin has no value. I don't think there's any possibility that 100 years from now, gold will not have a value, because gold had a value 100 years in the past. It had a value 1,000 years in the past. It had a value 4,000 years in the past. I think it's very unlikely that 1,000 years from now, gold would have no value. However, I think it's very, very likely that 1,000 years from now, Bitcoin will have no value, and Bitcoin could also have no value in 50 years. So I don't necessarily consider it a gold substitute, but I do think that it can be very challenging to try to figure out how to make it a useful and consistent currency without some type of regulation, which the Bitcoin crowd doesn't want. So you just got to deal with it how you're dealing with it. The Chicago Fed National Activity Index fell to minus 1.09 in February. We want to continue to monitor that. That is economic activity for the nation. That's the lowest it's been since last year around the same time. So we're trying to figure out if we really are having a recovery and things are getting back to normal. How come this number is as low as it's been since last year? And let's look at it when we put it out next month. or whenever the next number gets released, and try to kind of create a benchmark to understand what is going to be the comparison to the last number, which was reported today and also last year around the same time. Now let's get into the jump outs. Let's look at Starbucks. It went up around 1.116%. And one of the reasons that we believe it went up today from a fundamental standpoint is that they released that they're going to have some methods involved for them to save water in their particular business. Sorry about that. So they're going to have some methods for them to save water in their business. And so we believe that the market had a very, very positive reception to that. And as a result, it went up around $1.23 or 1.16%. We're going to see if we get a continuation on that tomorrow. Then we look at AstraZeneca PLC. Now, AstraZeneca released information, or the headlines came out, they're saying that their particular vaccine is safe and effective. Now, we understand that safe and effective are subjective words without having a benchmark of data to really compare that to. And then we also have to agree with the benchmark of data. However, the market responded really, really favorably. We see that it gapped up on the open and it continued to work its way up over the course of the day. So what we're going to look for is the market going to continue to see that as something positive? And which company is really going to win this vaccine race and become kind of like the standard for COVID vaccines? Or are we going to see a lot of differentiation amongst vaccines to where, kind of like with certain medications, it all depends on what doctor you go to? Or will one vaccine maker be able to come in and essentially dominate the market for this COVID vaccine? Now, Kansas City Southern, information came out of the news came out that they got acquired, I believe, by a Canadian company. And we saw a massive gap up at their open. And then we know they pretty much traded horizontal the rest of the day. We talked about before, when you're looking at company A acquiring company B, in most circumstances, what will happen? Company B will go up because while the market will see it as very favorable, they will become very bullish. So what we talked about before is that in a situation like this is a buy the news. Normally, if you get the rumor first, you normally buy the rumor, then sell the news. That's for all my traders. With this scenario, there was really no rumor, just the news came out, so then everybody jumped on the news. Now let's talk about the topic of the day. What we want to ask is, do you prepare for seasonality in your investing? I want to tell you a quick world story, and then we're going to relate it back to investing, but I want you to kind of understand this because this very much has to do with human behavior. Used to do business with some Swedes up in, they were Swedes, so because they were up in Sweden. I'm tripping. And I used to buy a lot of email traffic from them. So I met them through Skype. Bought a lot of email traffic from them. In fact, they were probably my number one email vendors that sold me a lot of traffic. And one thing they talk about is like how bad the winters were up there. And then I also found out like in Sweden, in certain parts of Sweden, there's maybe like 4 or 5 months in which it gets dark and you're just in your house. So you have to prepare for that by making sure you got provisions and things of that nature, because you don't really want to come out and have to do a lot of things. And now that they live pretty much in a civilized world, but, you know, back in the day where they were not as civilized, there was a lot of effort that had to be made to make sure when that winter hit that you were going to be prepared. This exists in a lot of parts of Northern Europe where the winters are very bad. I was in the UK in the summer, I want to say almost a decade ago. And even though it was summertime, it was still relatively mild weather. And we was in like July. All right. So we got to understand is that I could just imagine how bad their winters are. And I was in London, and London is a southern part of the UK. So I can just imagine how it is in the Scottish Isles. So as a result, the behavior of a lot of Northern Europeans, it adapted to what? Seasonality. So what did they do? They felt like, okay, what we have to do during certain times of the year is we got to start seeking provisions because it's going to get so cold. It won't be safe to be outside. Food is going to be scarce. Firewood is going to be scarce. And so we got to be ready for that because we understand that we live in a world of seasonality. As the Europeans started to travel and start moving south, one thing he found out was that many of the people that he was coming in contact with, they were not as affected by seasonality. So I live in a part of the country where it gets cold maybe 2 to 3 months, and then it just gets hot again the rest of the year. When I was living in the southwest part of the state, it got cold maybe for 2 weeks, and then it was just hot the rest of the year. So you don't really have that seasonality. And one of the downsides of that is that you will kind of become complacent because you don't feel like you got to prepare for anything because the weather doesn't cue you in that things are changing. You pretty much wake up and every day is the same. And you get kind of caught in the Groundhog Day effect. And that's something that you got to really guard against because you'll look up and the year will be over and you would not have done anything because there aren't any cues coming from your environment that time is moving. Where when I moved to Georgia, it was very obvious that things were changing because the trees would change colors. The leaves would change colors on the trees. The weather would start to change, especially around like late August, early September. But I live in the state of Florida now. There's places in the state of Florida where it just gets hot, and it is just hot every day. Now it gets even hotter, but you don't get like a cold snap. It doesn't really happen like that. So therefore, seasonality is real, and it affects or affects, whichever word is correct, human behavior. Now, how does that relate to the market? Because seasonality is real, it affects not only human behavior, but it affects consumer behavior. So when you're looking at a company, far as an investor, ask yourself, how does seasonality affect human behavior, which then affects consumer behavior, which then will affect the revenue of the company that I'm in. So let's take example. Let's say you're invested in the gas company. Well, when do you think they're going to do the majority of their revenue? They're probably going to do it in the winter where everybody's burning gas. Then as they start to roll into the spring and the summer, their revenue may not be as great. Why? Because of seasonality. People aren't using gas like that. They may be using gas to cook, but they're definitely not going to be using gas to keep heat running through their house, right? Same thing if you're looking at maybe a fitness brand. They may have a lot of revenue coming in late time of the year, early time of the year, top of the year. However, as they start going into late spring, summer, people normally have gotten off their New Year resolution to lose weight. So you're not going to see that kind of revenue coming in. So seasonality affects human behavior, which then affects consumer behavior, which then affects the revenue of the particular company that you may be investing in or also trading. A lot of big funds understand this, and they have economists and they have trend experts come in and consult with them or either work for them to try to help them understand how seasonality is going to affect the share price of a particular company and whether they need to trade in or trade out of that company based on seasonality. So I forgot the name of this particular term. I keep forgetting it. It starts with an R. It's rotation. So a lot of rotations out of particular sectors or industries are based on seasonality, and funds very much do rotation. So they're talking about the rotation out of tech. Rotation is not anything new. It's something that's been going on forever because of seasonality in companies. Different companies will perform really well during certain times of the year. Other times of the year, they will not perform as well. So when you're managing a fund that's in a company that deals with seasonality, it may be better served for you to have your money in another company or in another area of the economy. You get the returns there because of seasonality, and then you move your particular money back into another area. And that's just that's just fund management. So what I want you to do is start looking at your portfolio, looking at what you're trading, and ask yourself, how does seasonality affect the performance of this particular company? And how can you, understanding seasonality, right, get better returns or protect your portfolio from a downturn in your portfolio if you choose to trade in and out of a position? So this is going to be David W. Williams, also known as Diamond Dave. Hit me up for the options trading course. Hit me up for the IPO course if you're already savvy in the options market. Both of those particular price points are going to be going up, especially the IPO course. That probably should be more than the actual fundamentals course, but we're going to work our way up over time. If you have any questions, hit me up in the comments. Like, share, subscribe. Talk to you later.